What's up YouTube? Welcome back. My name is Dylan. This is Investors Avenue and you are in the third and final video in the three-part series of analyzing financial statements. In the previous two videos, you guys saw us analyze an income statement and a balance sheet. So if you have not watched those, I've left links in the description below. I encourage you to watch those at the conclusion of this video. But today we're going to look at a cash flow statement. We're going to help you guys understand what is in a cash flow statement and some key important things to look for before investing in a company. So let's go ahead and hop over onto the computer and we will analyze a cash flow statement. All right, so here we are on Microsoft's cash flow statement. You can see that we are looking at annual data, period ending June 30th, 2019, and all our units are in millions except for the per share items. So what is a cash flow statement? A cash flow statement shows the actual cash received by a company or the cash paid by the company for a particular period of time. The reason the cash flow statement is so important is because most companies today use accrual accounting, which means income and expenses are recorded as they occur regardless of whether or not cash has actually changed hands. An excellent example is a sale on credit. So if the company sells an item on credit, they can recognize that revenue on the income statement. However, they have not actually received any cash for that sale. All right, so the cash flow statement's broken down into three sections. You have cash from operations, which includes everyday ongoing business operations, cash generated by the company by selling its products or services. Next, you have cash generated from financing activities, which includes issuing or repurchasing common stock, issuing or repaying debt, and also paying dividends. And lastly, you have cash generated from investing activities, which includes property, plant, and equipment additions, so capital expenditures, also acquisitions and sales of companies, purchases and sales of investments, and also maturities of investments. So those are the three sections. We're going to start with looking at the operations section. So when you analyze the operations section, you always start with net income, and we're going to add back any non-cash expenses from the income statement. So depreciation, amortization, and stock-based compensation are both non-cash expenses that were expense line items on the income statement. So if you dig through the company's income statement, you look at the 10K, you will see that there is expense in there for depreciation and also stock-based compensation. Since those were taken out of net income originally, we want to add them back to net income because it is not an actual outlay of cash for the company. Next, we have net gains and losses on investments in derivatives. So you see $792 million here. The reason it's negative is because in the period on the income statement, Microsoft reported a $792 million gain on an investment. So net income included that value. So here we need to take it back out. So next is deferred income taxes. If you look up here in the upper right, an increase in an asset is a cash outflow. A decrease in an asset is a cash inflow. An increase in a liability is a cash inflow. And a decrease in a liability is a cash outflow. So in this case, deferred income taxes is negative. Microsoft has a deferred income tax liability on their balance sheet. So since this is a cash outflow, that tells me that Microsoft's deferred income tax liability decreased over the period and they have a negative $6.4 billion cash outflow. So for the remaining sections, accounts receivable, inventories, other long-term assets, accounts payable, unearned revenue, income taxes, other current liabilities, other long-term liabilities. What we do is we look at the change over the period from the balance sheet and we can see whether or not the company had a cash outflow or a cash inflow. So if we look at accounts receivable, we can see that it is a cash outflow, so that means over the period accounts receivable increased. Looking at inventory, it's a cash inflow. So the company had a decrease in inventory in the period. Other current assets increased because it's a cash outflow. Other long-term assets increased, so it's a cash outflow. An increase in accounts payable resulted in a cash inflow. An increase in unearned revenue resulted in a cash inflow. An increase in income tax resulted in a cash inflow. An increase in other current liabilities resulted in a cash inflow. And lastly, an increase in other long-term liabilities resulted in a cash inflow. So if we think about this, let's take, for example, accounts receivable. A company in the period sold more on credit than they received in cash. Thus, accounts receivable went up. Thus, they did not receive the cash that they could have had they not sold the items on credit. Thus, it is a cash outflow because accounts receivable went up. So just remember the little cheat sheet up here in the upper right. It will help you when analyzing a cash flow statement for changes in assets and liability, which is also sometimes known as working capital. So if you look at a standardized version of the cash flow statement, Rocket Financial does a good job with this. They put here change in working capital. You hear this mentioned sometime, working capital. What working capital is a change in assets over the period minus a change in liabilities over the period. And those are both current assets and current liabilities. So you can see they put in here accounts receivable, inventories, other current assets, accounts payable, deferred revenues, other. So it's just a change in current assets and current liabilities over the period. And that delta is known as the change in working capital. So after you sum all those totals up, you get net cash from operations. So $52.185 billion for the period for Microsoft. The next section we're going to look at is net cash used in financing. So the first line item is repayments of debt. So that says Microsoft paid $4 billion worth of debt down in the period. The next line item is common stock issued. So the company issued just over $1.1 billion in common stock. The next line item is common stock repurchased. So Microsoft in the period purchased $19.5 billion worth of their common stock. Next is common stock cash dividends paid. So Microsoft paid $13.8 billion in dividends in the period to their shareholders. And the last section, it doesn't break down any further, but that's other net. So there was a $675 million cash outflow for other financing activities in the period. The last section on the cash flow statement is the investing section. So the first thing you always see in the investing section is property, plant, and equipment, or capital expenditures. And this shows us here that Microsoft paid $13.925 billion on capital expenditures in the period. The next line item, 2.388, Microsoft spent that amount on the acquisition of companies or intangible assets. The next line item is purchase of investments, $57.697 billion worth of investments purchased by Microsoft in the period. The next line item is maturities of investments. So Microsoft received $20 billion in cash for the maturities of investments. And the last line item is sales of investments. So the company received $38.194 billion in the period for sale on investments that they had. So that is a cash flow statement in a nutshell. So now I'm going to give you guys a couple tips, a few things to look for when analyzing a cash flow statement. So the first thing you want to look for in the cash flow statement is capital expenditures to be under control. So ideally we want to see capital expenditures less than 50% of net income. Preferably we want to see under 25, but under 50 is acceptable. So go look at a company over a 10-year period, compare capital expenditures to net income, and we want to ideally see them under 50%, preferably under 25, and this may show you a company that has a long-term durable competitive advantage. We don't want to see a company spending a lot of money on capital expenditures. Traditional value investors don't like capital expenditures. Companies that have to spend a lot on CapEx can usually lose their competitive advantage if their money dries up or they're not able to spend as much. So good long-term companies that have competitive advantages typically only spend on capital expenditures to replace equipment when it wears out. You also want to look for a history of share repurchases. This may show a competitive advantage. One thing to be aware of though is we want to make sure a company is not taking on a lot of debt to repurchase its own shares. But a company like Microsoft is repurchasing a lot of shares, which adds value to shareholders. And lastly, we want to look for positive and increasing free cash flow. So what free cash flow is you take cash flow from operations, subtract capital expenditures, and you come up with free cash flow. So we want to see that increasing over a period of time. So if we look at Microsoft's free cash flow, we could see that Microsoft back in 2006 had $2.8 billion of free cash flow, and now here in 2019 they have $38.3 billion of free cash flow. So a very good positive uptrend for the company. All right, so a couple notes to remember when looking at the cash flow statement, particularly the section for operations. The top section, you always want to take net income, add back depreciation and amortization, add any losses in the period, and subtract any gains in the period. So a reminder, asset increase equals cash outflow, asset decrease equals cash inflow, liabilities increase equals cash inflow, and liabilities decrease equals cash outflow. So this section breaks down all three sections of the cash flow statement. So we start with net income in the operating activity section. We want to add back depreciation and amortization. Then we want to add or subtract any one-time adjustments, which is investment gains or losses not related to operations, any deferred taxes, stock compensation, etc. And then we want to add or subtract the changes in working capital. So remember, working capital is the changes in current assets minus the changes in current liabilities over the period, and that is the change in working capital. When you sum all those up, you get cash flow from operations. Next is investing activities. We want to take net change in capital expenditures, net change in investments, and that equals cash flow from investing activities. And lastly, we got financing activities where we subtract dividends, add or subtract the sale or purchase of any common stock, add or subtract the cost of any net borrowings, and that equals cash flow from financing activities. All right, so that concludes the cash statement analysis video. Hopefully you guys found this interesting. Please give this video a thumbs up if you liked it. Please leave me a comment. And I also encourage you to subscribe to see more videos like this in the future. The cash flow statement is a lot simpler than the income statement and the balance sheet statement. Those require a lot more analysis and in-depth review. So I encourage you guys to check those out. I've left links down below, and I've also got the videos posted over here on the right-hand side. So I encourage you to check those out. Leave me a comment. Let me know if you want to see me analyze any of the financial statements from any companies you may be looking to invest in, and I will see you guys in the next video. Thanks.